Okay, welcome back to the Master Trader Program, Super Performance Workshop. I'm Mark Minervini, you know that by now, and I'm here with David Ryan. Let's take a look and recap what we've gone over so far here on day one. Categories and catalysts. We talked about the various categories, the leader, the market leader, the top competitor, institutional favorite, turnaround situations. We briefly talked about cyclicals and their inverse PE cycle. Valuation. We talked about valuation, and basically we don't really use valuation very much with growth stocks, because when we go with the very high earnings, and when you get that strong earnings growth, it's really hard to put an appropriate valuation on a fast growing company. And that's why there's the opportunity. That's because you really can't forecast very far out. The trend, talked about the 4 stages of a trend and how we want to be in a stage 2 uptrend, because in stage 1, we're losing time. Stage 3, we're losing time. Stage 4, we're losing value. Only in stage 2 are we increasing value and making up time, because things are moving very quickly. And then, of course, fundamentals. We talked about the fundamentals. 3 things we spoke about: earnings, sales, and margins. And I showed you a bunch of different ways to look at those and slice and dice those numbers. But remember, we're only looking at earnings, sales, and margins. You don't need to go into all kinds of esoteric calculations. When you're dealing with growth stocks, you look for growth, and that comes up in the earnings, and that stems from your margin growth, margin expansion, and your revenue growth. So now we're going to start off with what we call a picture is worth $1 million. And this is how to identify the price patterns that are within the stage 2 uptrend. So now, once we've established that we're in a stage 2 uptrend, we're going to start looking for consolidations. Everything we do is on continuations, continuation patterns, continuation of earnings information. So we're looking for existing trends to already present themselves, and then we're trying to get involved in the portion of that trend where things start moving pretty quickly, and again, we can maximize compounding, of course. So, without getting into getting too deep into the various patterns, if you will, all the patterns that I use are going to have what I call VCP characteristics. You're going to hear that a lot. We're going to get into that in a little bit. But whether it's what's called a cup completion cheat or a low cheat, we're going to cover that. That's one of my signature price patterns. The cup with handle, of course, that was popularized by William O'Neill. Double bottoms, Darvas boxes, and power plays. These are basically the 5 patterns that I'm looking for. Pretty much 98% of the time, 99% of the time, they'll fall into these categories. What's important is that you remember, like I said before, everything builds on each other. So nothing that we say now erases or negates anything that we said previously. So we want to be in that stage 2 uptrend, right? And then we're looking for this consolidation to take place, where the stock takes some time to consolidate those gains and then continue. As it starts to continue and move back up out of that consolidation, we're then looking to get on board. So now, what's most important is the long-term trend, because we're not even going to consider a stock unless it's in a stage 2 uptrend. Then the current price action. Then we're looking at the current price action to see if we can find those consolidations within that stage 2 uptrend. And then from there is an entry point, and we're looking for a low-risk entry point. Now, most of all of the stocks that David and I are going to be buying are going to be relatively close to a new high, a new price high. And for some of you, that's no big deal. You're used to buying stocks near new highs, and that's just par for the course. But for many, it comes as a strange concept. Especially if you're new to the stock market, you've probably heard buy low, sell high, or you see a stock trading at a new high and you're thinking to yourself, wow, that looks expensive. Why would I buy there? I want to buy it low before it makes that new high. Well, that's really not how it works when you deal with a big move in a stock, particularly if you're going for a really big move. What happens is for a stock to go from 30 to 31 to 32 and go from, say $30 to $100 or $300, it's going to have to hit a new high pretty much the entire time. When you take a look here, this is Microsoft, and these little dots right here, they represent each time the stock made an all-time high. What I want you to focus on is to see that all the progress, do you notice how all the progress, all the upward progress is all dots? See, when there's no dots, the stock's not really moving anywhere, just moving sideways. But then you get the little dots and the stock's moving up, and then it goes sideways. So you want to be involved when you're making those new highs.
Yeah, and one of the reasons why new highs are great, especially new highs that go over that are at least a 6-month high or 1 year or a 2-year high or even longer, is that there's no one above you. There's no one who's recently bought at a higher price. And so it's like clear sailing. The only people that are selling when it gets into new highs in price are people that are taking profits. So.
Right. So you have a lot of happy customers. Let's put it that way. But we're going to be talking about what David's referring to is what we call overhead supply. And we're going to be talking about overhead supply. You're going to hear that from time to time, and we're going to get into that in a little while. So we'll talk about overhead supply, and that's where you have people that bought the stock at higher prices, and now as the stock comes back up to those prices, they're just getting even. So they might want to sell the stock. So we're gonna look at that in a little bit. But now going back to why you want new highs is that really a stock can't make a huge move without making a new high. Here's this Monster beverage. Again, if you look at any stock that's made a big move, you're going to find that all the action, all the excitement, all the upward movement is when you have these black dots and you're making a new high. Now, let me show you something that's quite interesting. Dave, did you have something to say? I'm sorry.
No, well, I was just going to add that is that we're going to get into this that people are just saying, well, I just can't buy any new high. It's always you want to be buying a high as it's going in after a consolidation. But we're going to get to that later on.
Yeah, we're going to actually get to that very soon. Yes, so we'll get to that in just a second. And you'll see what David's talking about here. You're moving sideways here. And then as you start to get into that new high ground, that's where we're going to be looking to buy these stocks. But now take a look here. This is a perfect example. Here's where I actually bought Yahoo right here as it started making these little black dots right there in right around July of 1997. Now, this stock had already corrected, and then it came back, and when it made a new high, it was up 170%. So it was up almost 200% and trading at the highest price that it had traded since its IPO. So someone might have looked at it and said, wow, it's already up almost 200% and it's at its all-time high. But that was only just the beginning. That was the beginning of a very big move that took place. Excuse me. And this stock actually went up about 8,000% subsequent to this. Sorry about that. Hold on. Sorry about that. Okay, so this stock went up about 8,000%. And again, you can see all new highs, all black dots. And here, see where it goes sideways again? Just breaking out to new highs, now all black dots. So the real action happens even after the stock makes a big move. Let's take a look at another one. Let's take a look at Taser. This is another stock that I was buying. I was buying coming right out here. And again, this stock came off and came up 540% because it had a pretty big decline. So it made a 500% move. And then the real action started happening when it started hitting all-time highs. And then the stock went up additional 1,800% from there. So think about this. If a stock was to decline 50% and then you bought the exact low, you were clairvoyant enough to get the exact low, and then the stock went back up and you were going to sell it when it hit an all-time high, the maximum that you would make would be 100%. That's it. It goes up 100%, cuts in half. Stock goes from 100 to 50 to come back up to new highs and hit that all-time high. It goes from 50 to 100. That's 100%. Look how much you leave on the table, right? Because the real action is happening subsequent to that all-time high. So this is just, again, I'm setting a little perspective here once again. And we're going to be looking at buying stocks that are at or near new highs, It could be, sometimes they'll be 15, even 20% below the high, the 52-week high, but very often they're actually going right into all-time high ground. So now another thing I want to talk about is where are we looking to buy these stocks at these new highs? And of course, we're not looking to buy the general market near new highs. Okay, although that could happen. It could happen where stocks are starting to emerge into new high ground and they're meeting our criteria and the market is going into new highs. But generally speaking, and looking back in history, 96% of big winning stocks and fast moving stocks, they start their move from a correction, from either a correction in the market or a bear market or a large correction, a large bear market. And what we found is that you've got basically there's three really great opportunities to look for these leading stocks and look for stocks to be making these new highs. And sometimes they actually happen even before the market makes its low. So you'll get the general market is moving down, and sometimes it goes down in a couple waves. And even before you get the last wave down, you'll have some stocks start to break out of bases. And this is what we call a predictive move. So you'll have back in the 1990s, 1990, we bottomed in October of 90. And prior to that, there were stocks like U.S. Surgical and Amgen and a bunch of medical stocks. And I'll show you a few examples later on. American Power Conversion, Ballard Medical Products, a whole bunch of stocks that I remember that I was in at that time. They were actually making new highs and they were holding up really well even before the market made a final low. Then you usually have a group of stocks that will start to emerge out of their bases and make new highs that we call coincident. And that's where they're coming right off the market low. Usually you'll see those stocks break out right around the time you get a follow-through day. As for those of you that don't know what a follow-through day means, that's the O'Neill follow-through day where the market gives you a signal based on volume and accumulation in the averages that you get a good indication that you've made a bottom. That's something that you can pick up William O'Neill's book and take a look at. But a lot of times we'll see stocks break out right around that time when you get a follow-through day, which we call coincident, usually coming right off the lows in the first, sometimes 5, 10, 15 days off the lows. And then as the market starts to move higher and maybe you get a pullback or two, you'll get what we call confirming. And that's where you put in a good sized bottom and the market now is in a pretty strong uptrend. And then you get some more stocks. And these are sort of the opportune moments that you have. So when you, and what all this really means, and what I'm trying to get at here is that corrections are good. Correct. I mean, they're not good if you get stuck in them and you don't cut your losses and you're holding big declining stocks, but you should be in cash. Okay. If you use, we're going to have a bunch of sell rules. We're going to show you later on. If you're using this right sell rules and you're cutting your losses, you'll be in cash during bear markets and you'll be ready and prepared for these opportune moments. And so, when they finally show up, this is where you have a really golden opportunity because this is where a lot of the big winners will emerge and you can get onto them very early. And Dave, I'm sure you've had your share of stocks that you bought going into new bull markets, coming off of bear markets. Maybe you could share some stories.
Yeah, what I was going to add too is when you're in that down phase, before you even get the predictive, is that the market leaders and the markets usually come down in waves or in maybe like 3 phases. And I call it about, making 3 lower lows or the market comes down. But as the correction goes on, just like that, as the correction goes on, the strongest stocks, yes, on that first move down, they're going to get hit. On the second move down, they're not going to get a hit as hard, and they might not make new lows at that point. They're starting to resist the decline. And by the third low, those are already turning up and going. And so the market leaders, and that's what's great about a correction or a bear market, the market leaders are going to start showing themselves probably halfway to 2/3 during the correction or the bear market. And sometimes these stocks hit lows and start turning up and actually start making highs months. I've seen it where 1982, in the August 82 low, a number of stocks, a lot of retailers were making their lows and actually turning and going into new high ground 2 to 3 months before the market actually bottomed. So there's a lot of predictive action going on even before the overall market hits a low.
And a perfect example here is Walmart. So this is the 82 market bottom, and you can see, as Dave said, you came down in one, two, three waves before you made the final low. And this is Walmart. Now, keep in mind, Walmart at this time is not the Walmart that you know now. This is a small company. At this time, back in the 80s, Sam Walton, founder of Walmart, was standing on a soapbox in front of the stores, flagging people to come in, and the stock was trading, very small amount of shares. You're talking sometimes this stock traded just several thousand shares a day. So this was a small company that was relatively small company that was growing its earnings very rapidly. And you can see here, you come out and you go into new. This is a new high right here after the first leg down. So when the market came off, this is where you're saying, wow, this market's, in bad shape here. It's selling off. But this stock was poking its head into new high ground. That should have got your attention that, hey, something's going on here. This stock is really strong in a weak market. Now the market, the index here, the Dow, comes down and makes another low, rolls over. Look what happens to Walmart. It just builds another base on top of the other base. And as soon as it starts to turn up, bang, it comes into new high ground again. So this is, you could have been buying this stock here, either here or here. And then finally, you roll over again. The market makes that third wave down. And look, Walmart's already out and just having a natural pullback right now. And then when you come off of that low, wham, it's going really into new high ground. It's already made a pretty big move, and the market is just bottomed and hasn't even gotten going yet. Something I need to point out here real quick, because you're probably looking here and going, oh, Walmart was a 35-cent stock. No, all these prices at least on many of these stocks are adjusted for splits. So these prices were much higher, but they're adjusted for splits. So it might show that it's a 5-cent stock or a penny stock, but none of these were penny stocks. So I just want to point that out. Let's take a look also at another one. So Apple Computer. So here's another one. We go into a correction. This wasn't a big bear market, but 04, we had a correction in the market. And again, 1, 2, 3 waves down, right? Right off of that first wave down, as you start to turn up just from that initial pullback, you see right here, Apple formed a nice big base into new high ground. Now, again, you form this little base and you get a nice follow-up little buy point as you come down again and as you start turning up from that low. And by the time you have that third leg down and you finally make a low, you're on the third opportunity to buy Apple from a base. You've got 3 buys now. And from that point, stock went up over 125% just in 6 months. Let's take a look at Amazon, of course, because everybody knows this one, right? Now, this is sort of what happens with most leaders. You're going to see that virtually every stock market leader in a cycle, when you have a bear market, the leading stocks are going to bottom ahead of the market. And this is why corrections are great, because you get to really see what stands out, and you get a pretty good lead time. So you really get to prepare for the next wave of the best stocks, because they're going to make their lows. Here you see Amazon makes a low here, and then it turns up, and it's not into stage 2 uptrend. Remember, we talked about the 4 stages, right? We don't want to buy a stock unless it's in stage 2 uptrend. Well, we're now in a stage 2 uptrend right here. And this is where the stock has that consolidation. Remember, we talked about we want to look for the consolidation within the stage 2 uptrend. So this is your first consolidation after you're in a stage 2 uptrend. If you can see here, stock bottoms here, market doesn't bottom all the way till here. And Amazon is moving out of that consolidation in what manner? Remember, we said predictive, coincident, and confirming. This is right off the lows. That's coincident, right? So that's coming out coincident with the market low. And now that breaks out. And by the time the market actually gets into an uptrend itself, into a stage 2 uptrend, stock's long gone. Stock has already moved from 20 to over 40. It's already doubled. And this stock went up 240% in just a year. These are the type of stocks you want to find. And if you can make these type of percentage moves, you really change your account size pretty quickly. Let's look at eBay. So eBay is another one where you see here's where the market bottoms here. I got to compare it to the NASDAQ, of course. And we're coming, again, coincident. See, we're just turning into a stage 2 uptrend. All this is all stage 1. you really haven't gotten yourself into a stage two uptrend yet. It was back and forth and volatile. And now you've got yourself into a stage two uptrend and you consolidate right coming off of the market low. And because, and a lot of times, and this is something, Dave, maybe you could talk about, particularly in a correction. I know you like to look for those relative strength lines hitting new highs.
Yep.
Why do we want to look for those relative strength lines hitting new highs when we're in a bear market, Dave?
Well, because those are the stocks that are outperforming the market and outperforming most stocks. And so when you have a relative strength line in an uptrend and the market is going sideways, this is a stock that's resisting the decline. And usually those are going to be the ones that when the weight of the market comes off, they're really going to take off and be the big leaders. So relative strength, the relative strength line is so important to spot, especially in a very tough market.
Right. And MarketSmith has a great little feature where you can just click a button and you choose relative strength line new high, and it will bring up all the stocks that have a relative strength line hitting a new high. This is a great screen to run, or you can toggle that on your current screen when the market's in a correction or in a bear market, because that will have you focus on the stocks that are holding up. Now, keep in mind, a stock doesn't even have to go up. It could go sideways while the market goes down, and it's outperforming. So the market's going down and the stock's going sideways, the relative strength line is going to go up. Even if the stock goes down less than the market goes down, say 30%, stock only goes down 10%. So it's outperformed by 20%. The relative strength line is going to be moving up, and it will pick that up. And when that starts hitting new high ground, that's telling you that you're outperforming, and the stock could then follow suit and maybe hit new high ground. So again, eBay went up 225% in just 23 months from that point. Another thing I want to point out is that notwithstanding the names that go back before I was trading, I started trading in '83, and most of these examples are from my own trading. They're from either the '80s or many of them are the '90s and going forward. But 90%, 95% of all the stocks that we're showing you here, I personally traded. These are not, we didn't go back and say, hey, let's go find the stocks that, corroborate what we're saying. These were traded in real time at the time when I didn't have the benefit of this hindsight. I didn't know it was going to go up 220% in 14 months. So again, this is real life stuff. This isn't just curve fitting and back testing and all that crap. This is real life stuff, and I'm showing you the majority of the examples. Now, there's a lot of examples that stocks that I missed that were perfect setups, and I'm going to show you those also because I include those in my model book work. And there's also going to be stocks that I screwed up on, and I had to figure out why I messed up on them. They end up maybe turn out to be big winners, and I sold them too soon. Lumber Liquidators is one of those. Is one that I sold too soon. But I was in this stock buying it here. You can see again, you're in a correction, right? And now this stock just has a consolidation, moves into new high ground. Again, this looks coincident, right? It's coming right off the lows. And again, this was one of the first stocks to go into new high ground coming off the lows of this correction. And those are, when we go all the way back to when we started with categories, those are your market leaders. These are your market leaders. They're going to look expensive. They're going to have the high relative strength. They're usually going to have the superior earnings, and they're going to have the high PEs. They're not going to be cheap, and they might be tough for you to buy. You might think that they're expensive, but just the fact that this is one of the first stocks going to new high ground right off the market lows, that tells you this is a stock that wants higher.
And usually the names that are starting to go into new high ground, these are actually new names, and a lot of them you're not going to be familiar with. They're names that are going to lead this next bull market, and it's not going to be the one that you made money on, in prior bull markets. In a lot of cases, there'll be names where you're going to go, what in the world do they do? And you have to get up to speed very, very quickly. When you see a stock going into new high ground in a tough market, you have to find out what they do and check out their numbers to see if you've got a new market leader on your hands.
Yeah, usually leaders that led in a prior cycle don't lead the next cycle, and the best, their best move is behind them. I know we've had a pretty big secular move in FANG stocks, and that might be an exception, and we're in a sort of a nifty 50 environment. But again, you probably going forward from here, you probably won't see the FANG stocks be leaders anymore. It's going to be names that you're going to have to get familiar with that you may not know. At one time, Amazon and even Microsoft and names like Dell Computer and Home Depot, they were not widely known at all. When I was first buying Amazon and Yahoo and all these names that are household names now, very few people had heard of them. Let's move on here. So Humana, this stock went up 1,000% in 38 months from this point. And this is an example of another coincident move. You can see almost to right off the low, almost to the day of the low, this stock emerges into new high ground right as the market, I'm sorry, is bottoming. Now this is in 1978. I wasn't trading back then, so this comes from our model book of stocks, of leading stocks that set up. So we've studied them all the way back. We've got models going all the way back to the 1800s, and nowadays there's a lot of O'Neill's put out model books, and they have IBD and MarketSmith. They have model books that they've done each year with the leading stocks, the biggest winning stocks of each year that you could purchase. So there's so much information now, and so many examples that you could be using. Here's a stock that I bought that really, this is one that I made almost 100% on, but boy, did I sell it too early. It went on to go up 2,500% in 42 months, and I think it went even much higher from there. But this is where you get that leverage that I talked about before, where you buy a stock, and if you get it off the market low, even if you were to get it right off the market low, you see here the Nasdaq went up about 18%. Right? I call it 20%. This stock goes up almost 100% during that time. That's how you get your leverage on the market, by being in the leading stocks. Those are the ones that can make really big moves in a relatively short period of time. Sometimes you get these stocks, they'll go up 50%, 100% in just a number of weeks. So do the math. You start compounding those type of moves. They can really add up over time in a pretty short period of time. The interesting about this stock is that this stock actually went into new high ground the day before the market made the absolute low. So it's almost to the day right off the low. Talk about coincident with a bottom. Let's see here. WR Grace. This is another stock that I bought coming off of a correction. This was the '04 correction again. Coming off the correction, you can see right here they actually had some an asbestos lawsuit issue, and it started to resolve itself. But this stock right here in 55 days, stock went up 147%, almost 150%. During that same time, the S&P went up 9%. So you see, when you time these trades right, and you buy them coming out of the bases within the uptrends and coming off of those corrections, you get that leverage on the market. You get that leader leverage, I call it, where the leaders can move have a big move in a very short period of time. And while the S&P only has to go up 10, 15, 20%, you can get doubles and triples out of the leading stocks. Let's show you a few more. I want to show you a bunch of examples here. Dave, I'm sure you remember, a lot of these CMG, of course. Now CMG is more confirming, where you see the market already bottomed, and now it's starting to break out during this bottoming process. So this came out of this base, another, really nice base. Now, again, remember, what do these all have in common? What do all these stocks have in common? They're all going into, well, they all have a stage two uptrends. First of all, every one of them is in a stage two uptrend. They're coming out of a consolidation, but they're all going into new high ground or very close to a new high. All right. And that's what we talked about earlier. Now, more recently, DocuSign. Here's isn't this so similar to when we look at lumber liquidators and some of these other stocks where they came right out off the lows, and then you got that leverage that I'm talking about? Well, DocuSign was no different. right? This is the same thing that's been happening. You can go all the way back to the 1930s, and you'll see Coca-Cola was doing this, and it was a growth stock back then. So you see all-time high right off the lows, right? And now market moves up 36%, DocuSign up 120%. So again, you get that leverage on the market by being in the leaders coming off of the market corrections. Dave, you remember American Power Conversion?
Oh, yeah.
I don't know if you were in this one, but this is a stock that I bought right here on this day as we came out. Now, I want to show you something. If you can see this black line right here, that's the general market. That's the S&P 500. And this, of course, is the stock. Now, you can see the stock's in an uptrend. It's in a stage 2 uptrend, but look at the relative strength line. New high, and then new high here. So as the market's correcting, the relative strength line is going into new high ground. Now, this may not look it here because the stock's not in new high ground yet, and it hasn't really put in a big basing period, but the relative strength line is already giving you that tip off. It's moving into new high ground, and it's edging its way into new high ground. Why? Because the stock is moving sideways and holding up in a base while the market is correcting. So you're getting that tip off, and now finally, when it completes that base, it turns up right off the market lows, and boom, you got yourself a new market leader. Here's another one, Ballard Medical Products. So this was another stock that I was buying right here, right on this day, breaking out into new high ground. You can see bear market, right? See, the stock is moving sideways. So during that time, the relative strength is hitting new highs, giving you that tip off. Again, like I said, MarketSmith has a very simple little toggle button, and you can hit that, and it'll tell you the stocks that are having relative strength lines hitting new highs. This is a great thing to look for during a bear market. And let's take a look on a weekly. This is the same stock. This is Ballard Medical Products, but on a weekly. This you could see it more clear cut. This right here may not look like much. Dave, you remember the 1990 bear market in October of 1990? I remember just everybody was calling for like a 1970s end of the world. It was the bearishness was so unbelievably thick. And this, like I said, this may not look at it, but this was a big bear market. This was a pretty big bear market. And you can see this stock is in an uptrend. As a matter of fact, this stock is in an uptrend all the way from the 80. This is the 87 crash. And since then, the stock has been in a long-term uptrend the entire time. So you've got way a lead time of seeing a stage 2 uptrend. And then it was just a matter of waiting for that opportune moment to buy it coming out of a base, coming from a correction.
Yeah, and then the other thing that was interesting at that same time, there were a number of other stocks that were forming cups and handles, like Home Depot and Costco. And I think this was when it was the invasion of Kuwait, and we were going to get into the war, I think in January. But a lot of these stocks were anticipating, I guess, a good outcome, because right on the first day we started bombing, everything broke out to the upside and started taking off.
I think that was January 15th, as a matter of fact. And Investors Business Daily actually ran a headline that said "Cup with handles proliferate."
Right.
Remember that? And they showed.
That's because I walked into Bill's office and I showed him all these charts of stocks that are forming these cups and handles. And he said, well, let's take it and let's put it right on the front page.
I still have it. I have that somewhere. I could break that out.
Oh,
I have that. And they showed a whole bunch of I think it was Microsoft, Philip Morris, Home Depot, Ballard Medical Products, U.S. Surgical, Amgen, all those names. They were all forming these big bases and breaking out. And it was just a textbook perfect bottom with all this leadership. And guess what? Very few people recognized it because everybody was so bearish. They weren't even thinking about buying stocks. I want to show you something else. This is a caveat, if you will, or an observation to show you another way that this can play out with relative strength. And sometimes it's a little tricky. So this right here, this stock, and you guys could guess what it is. Some of you will know right away, of course. The stock is on the top here, and this is the Nasdaq. So this is the 07-09 period where we had that very treacherous bear market. This was actually worse for me. I thought it was a worse bear market than even 2000, which was more prolonged and really appeared to be even a worse bear market. But this was really a tough period, even after it turned up. And one of the things here, if you take a look, this stock right here is Netflix. And I was actually buying, we're number 6 right here. That's where I was buying Netflix. But let me show you leading up to Netflix. This is what I was seeing, and it was sort of how I made a case for Netflix. And I want to show you a little caveat too about relative strength. So as the market is making new lows, and this is a brutal, brutal decline, during that time, the Netflix actually went up 125%. So, I mean, look how it's completely inverse. You got the market in a downtrend, in a stage 4 downtrend, and now you've got Netflix moves up 125% and starts getting itself into a stage 2 uptrend, right? But that's not, I'm not buying it there because we haven't consolidated yet. We haven't come out of any type of a consolidation or base and found the low risk entry point. But this definitely got my attention. And you can see right here at number 3, the relative strength line was moving into new high ground. See, so again, if you had that toggled on MarketSmith, that would have picked that up. Now, the market, as measured by the Nasdaq, you see this makes a new low. It's actually hitting new lows, and everybody's bearish down here. And look at Netflix. Netflix is obviously way off its lows, up over 100%, and just consolidating now. Now here's where it gets a little tricky. Some people will misinterpret this. You'll see that the relative strength line goes flat here, and it doesn't actually go into new high ground with the stock price. But what can happen is when you come off of a bear market low and you get a stock that's really strong early on, as the market is rolling over, the stock is moving up big, and you have this huge RS, this huge outperformance. What happens is a lot of times the stock will make its move, and then when the market finally turns up, the stock has already made the move. It's already laid the relative strength on the table, and it will consolidate and look like a laggard because now the market's moving up and it's actually underperforming. But you have to put it into perspective. This stock had already dramatically outperformed, and now it's just forming that next base. And now you get a confirming move, right? Now the market moves off the lows and it's moved quite a bit up the right side. And now Netflix comes out in a confirming fashion. So again, this stock went up from this point right here, went up 500% in a relatively short period of time, but then went up thousands and thousands of percent subsequent to that. Most of you know the Netflix story, of course. This is a weekly. Okay, looking at a weekly, this is the NASDAQ here, and this is Netflix. And you can see, again, there's the big strong uptrend. And now as the market moves up, Netflix goes sideways and forms that base, all within the context of a stage 2 uptrend. This is FSI International. This is another stock that I bought. It was a similar type situation where look at this strong move. It has this big move, but during that time, see that line right there? That's the general market. That's the S&P 500. So the S&P 500 is consolidating and correcting, kind of similar to what we've experienced since February this year, where we saw the market just moving, especially if you look at the Russell. This would look like the Russell, where you're moving sideways all that time. But look how the stock makes this big move. And then when it consolidates, you see the relative strength goes sideways. So you don't get that relative outperformance. You actually get a degree of underperformance, but then you break out of the base and it comes out in a confirming fashion. So let me show you a few things here. I'm not going to go through all this in detail, but this is what you want to look for when the market's in a correction. And the theme of this section is to be able to spot the leaders while the market's in correction. That's not a time to take a vacation. Right, Dave? I mean, this is the time really to roll up your sleeves, right? And when you're in a correction, I mean, you're starting to lick your chops when you start to see stocks setting up in a correction, right?
Oh yeah. To me, it's easy to see which are the stocks that are the leaders or might be the leaders in the next bull market are the ones that are holding up the best. And I'm not talking like utility stocks, But growth stocks that have earnings, the ones that resist the decline will be the leaders. So it's actually the best stocks actually stand out a lot more than when everything is going up at the same time. It's actually easier to find the leaders as the market's coming down.
Yeah, I love corrections, and history shows that 96% of big moving super performance stocks emerge from bear markets and general market corrections. So you embrace corrections, and that's where you want to prepare and get ready to spot those next big moving stocks. So now when you're forming or when you're in a bear market and you've come off a few legs down, you want to start looking, coming off the lows, when the market rallies off the lows, stocks hitting the new 52-week high list. What stocks are hitting the new 52-week high list during that time? Stocks that corrected the least amount percentage-wise. So the market's down 30%, you start to see stocks. I'll run my screen, and then I'll sort it in percentage decline, being the least amount of decline first and down. So I'm looking at the strongest stocks that are holding up the best during the market decline. So stocks, and you don't want them to correct more than 20-25%. If you're looking at really deep corrections, now they're underperforming and they're not performing enough, and the declines are too big, or they've got to make too big of a move to get back to old highs. Stocks that surged in price off the lows, the stocks that really move and make the biggest percentage moves off the lows, those are stocks to keep an eye on, because like Netflix, you saw that nice big move up 125% while the market's correcting. That was telling you something's going on there, and the stock was discounting it. And then you're looking for stocks base building, stocks that are building bases and even moving sideways. If the market's correcting, that's going to get the relative strength to pick up, and you want to see a proliferation of that. You want to see more and more stocks setting up that way and holding up that way, and that's going to form the basis for your buy list and what you're going to start looking for potential buy candidates. Okay, we're going to just take a very short break, and then we'll be right.
Mark, I just wanted to add one thing to this. If you hadn't sold many stocks, or you're coming down with a lot of stocks that you're underwater on, it's going to be much harder for you to have the right frame of mind to be looking for these next new leaders. And that's why it's so important. And I guess we'll get to it about how to sell and when to sell. Is that if you're selling correctly and as the market's just rolling over, then you're going to have a lot of cash looking for these opportunities, and you're going to be in a much better frame of mind because you haven't lost much off the top, and you'll be ready to find these stocks as they start resisting the decline in a bear market.
Absolutely. And I'm being told actually that we're not taking a very short break, that actually we're wrapping up right now for day one, and then we'll be coming back tomorrow for day two. So again, I thought we were moving on to another section, but I'm certainly getting tired here, so it's a good time to wrap it up. So we'll see you tomorrow, and we're going to wrap it up for today. Okay. See you tomorrow.